Welcome back to the deep dive. Today, we are taking a really focused look at Enphase Energy's financials, specifically just the CFO's opening remarks from their Q3 2025 earnings call.
That's right. We're stripping away everything else to really hone in on the core numbers and what they mean.
And the setup is interesting. Q3, the results looked really strong on the surface, great revenue. But then the Q4 forecast came out and it was, well, much more cautious, almost like financial whiplash.
Definitely a contrast.
So our mission today is to kind of dissect that. What was real strength in Q3? What was maybe temporary? And why does the immediate future look quite a bit softer?
And focusing just on the CFO's part gives us, that crucial insight into profitability, things like margins, tariffs, and also liquidity like cash flow and those big tax credits. It's about understanding the real operational health.
Okay, let's start with Q3 then. The headline revenue number was $410.4 million. Seems pretty solid.
Yeah, on its face, a strong number. And it wasn't just revenue. It was actual product moving out the door. Shipments were very strong. They moved, 784.6 megawatts DC of microinverters.
Okay.
And the IQ batteries hit a record 195 megawatt hours shipped just in that quarter. That's a lot of batteries.
A record, wow. But, okay, here's the nuance, right? The CFO immediately flagged this thing called safe harbor revenue.
Ah, yes, the safe harbor. Crucial context.
Q3 included $70.9 million of that, a pretty significant chunk.
It really is, $70.9 million. And what that means essentially is sales to customers who are basically stockpiling. They plan to install that inventory over more than a year.
So it's revenue pulled forward from the future, basically.
Exactly. It gives Q3 this significant but kind of one-time boost. You almost have to mentally subtract that 70 million to see the underlying quarterly run rate.
Got it. Okay, so even with that caveat, profitability looked good.
It did, yeah. The non-GAAP net income was $170.3 million, which translates to an adjusted EPS, diluted EPS, of $0.90. And that's a big jump from $0.69 in Q2.
90 cents EPS. So yeah, including that safe harbor bump, Q3 looks like a monster quarter in the bottom line, too.
Definitely. But the question then becomes, how sustainable is that? What about the actual margins on those sales? Were they keeping costs in check?
Right, let's dig into the gross margins. The adjusted GM for Q3 was 49.2%. That's actually up a bit from Q2 and, frankly, pretty high for this sector.
It is high, very high. But you really have to remember where a big chunk of that is coming from. The CFO pointed out that the total margin included a $42.5 million net benefit from the IRA, the Inflation Reduction Act.
$42.5 million just from the IRA.
Yeah. So that's not purely operational efficiency driving that margin.
Yeah.
It's significant government support baked in.
Okay, that makes sense. But they're also dealing with headwinds, aren't they? Tariffs.
Oh, absolutely. The CFO was clear on that. Even with that big IRA tail end, the gross margins were negatively impacted by reciprocal tariffs by 4.9%. Almost 5 full percentage points knocked off the margin because of tariffs.
Wow. So it's like this push and pull. The IRA helps, the tariffs hurt.
Precisely. It highlights just how sensitive their margins are to these, external policy factors. The IRA is kind of masking the underlying tariff pain to some extent.
But they are managing costs elsewhere. You mentioned OPEX.
Yeah, that was one encouraging sign. Adjusted operating expenses, or OPEX, were kept pretty tight. $78.5 million. That's only up slightly from $77.8 million in Q2, even with higher revenue.
So good cost discipline there.
Seems like it, yeah. They're clearly focused on keeping that spending under control.
Okay, now speaking of how they report things, there was a notable change announced for Q4, right, about how they'll report gross margins going forward.
Yes, a significant shift in reporting policy. The CFO stated they will no longer guide or report gross margins without the net IRA credit included.
So the margin number we see from Q4 onwards will always have that IRA benefit baked in?
That's the plan. Effectively, the IRA benefit becomes the new baseline for how we should think about their margins.
Isn't the timing a bit convenient, though? They stop breaking out the IRA benefit right when revenue and volume are expected to drop in Q4. Doesn't that kind of muddy the waters on how the core product economics are performing, separate from the subsidy?
That's a fair question, and certainly one analyst will be watching.
Yeah.
The rationale the CFO gave was, twofold. First, most of their manufacturing is now happening in the U.S. because of the IRA. Second, the tariff impacts on the remaining international production are just too volatile.
Okay.
So they argue trying to constantly strip out the IRA numbers becoming complex and maybe not even that helpful anymore. It's now a structural part of their cost, essentially.
I see. So the message is Analyze our profitability with the IRA included from now on.
That seems to be it.
All right, let's pivot from the P&L to the balance sheet. How's our financial health looking? Cash position.
Looked pretty strong, at least on the surface. They ended Q3 with $1.48 billion in cash, cash equivalents, and marketable securities.
1.48 billion? That's a lot of cash.
It is. It's a very healthy cushion, and they'll need it because there's a big payment coming due. They expect to settle about $632.5 million in convertible notes next March 1st. And the plan is to use cash on hand for that.
Okay, so having that $1.48 billion buffer is pretty critical for handling that smoothly.
Absolutely. Avoids needing new debt or, issuing more stock right when they have to pay that off.
Now, here's something that really jumped out at me regarding their cash, or maybe lack of immediate cash. Those production tax credits, the PTCs.
Yes, the PTCs. This is probably the most important detail for understanding their actual liquidity right now.
The CFO reported $280 million in net PTC receivable on the balance sheet. That sounds like money they're owed but don't have yet.
Exactly right. It's $280 million they've earned from U.S. manufacturing under the IRA's direct pay option. But the key word is receivable. They haven't received the cash.
Okay, so when do they actually get that cash from the government?
Well, that's the kicker. There's a significant lag. The CFO broke it down. There's $108 million related to manufacturing back in 2024. They don't expect that cash from the IRS until Q2 of next year.
Q2 2026.
Correct, 2026. And then there's another $172 million from the first 9 months of this year, 2025.
And when does that arrive?
They're projecting sometime in the first half of 2027.
2027. Wow. So that $280 million receivable, it's like a giant IOU from the government that takes, over a year for some of it, and potentially up to 2 years or more for the rest to actually turn into spendable cash.
Precisely. It's earned, it's on the books as an asset, but it's not liquid. It's tied up in IRS processing timelines.
And that explains the cash flow situation in Q3, doesn't it?
It absolutely does. Despite that high headline revenue, Q3 operating cash flow was only $13.9 million.
Okay.
Which resulted in just $5.9 million of free cash flow, very low relative to the revenue and reported profit.
So low, in fact, that
they didn't repurchase any stock. The CFO explicitly mentioned that the limited free cash flow generation was the reason. The value is trapped in those receivables for now.
That timing lag is huge. Okay, so that covers Q3's complexities. Let's shift to the future, the Q4 forecast. What did the CFO guide?
Yeah, the Q4 outlook is definitely softer. Revenue is projected between $310 million and $350 million.
Quite a step down from Q3's $410 million.
It is. And the CFO gave basically two main reasons. First, obviously that big $70 million safe harbor boost from Q3 isn't repeating. That's gone.
Right, the one-time effect.
Second, they're deliberately slowing shipments into their sales channels. They want to help partners reduce their existing inventory levels, sort of a strategic destocking ahead of next year.
Okay, managing the channel inventory. Makes sense. And does that show up in the product shipment forecasts, too?
It does, especially batteries. The Q4 forecast for IQ batteries is 140 to 160 megawatt hours.
Down from that record 195 in Q3.
Yeah, a noticeable pullback, consistent with the overall revenue guidance.
And margins. If revenue and volume are down, margins likely follow.
Typically, yes. The adjusted gross margin guidance for Q4 is 42% to 45%.
Okay, 42 to 45%. Compare that to the 49.2% they just hit in Q3. That's a significant drop.
It is. Volume deleveraging likely plays a part there.
And are tariffs still a factor in that lower Q4 margin?
Still there. The CFO confirmed that the 42-45% guidance still includes about 5 percentage points of negative impact from those reciprocal tariffs.
So even as margins compress overall, that tariff headwind remains stubbornly fixed at around 5%.
It seems that way, yes. It's a persistent drag on profitability.
But OPEX discipline is holding.
That's the guidance. Adjusted operating expenses are forecast tightly between $77 million and $81 million. So they're aiming to keep operational spending relatively flat even as revenue declines quarter over quarter.
Okay, so pulling all this together from the CFO's remarks, Q3 looked great, but heavily boosted by that temporary safe harbor revenue.
Right. A big asterisk on Q3 revenue.
Underlying profitability is decent, but very sensitive to tariffs and heavily reliant on IRA benefits, which are now being baked into the main reporting number.
Correct. And the biggest story, perhaps, is the cash situation.
Yeah, that $1.48 billion cash balance looks good, but a huge chunk, $280 million, is actually tied up in PTC receivables with a really long wait time, like until 2026 and 2027 before it becomes actual usable cash.
Exactly. That's the key takeaway for you, the listener. There's this gap between the accounting profit, boosted by tax credits, and the actual cash flow, which is constrained by the multi-year delay in receiving those PTC refunds. Liquidity isn't quite what the balance sheet might first suggest.
Which leads to a really interesting final thought. The CFO mentioned they are evaluating opportunities to potentially get that PTC cash sooner.
Trying to accelerate it.
So, given they're stuck waiting potentially until 2027 for hundreds of millions via the standard direct pay process, what kind of financial creativity might they be exploring? Like, could they sell those future receivables or borrow against them? Some kind of financial engineering to bridge that gap and get that capital working sooner.
That's the multi-million-dollar question, isn't it? How do you make that massive government IOU liquid now instead of waiting years? It's a classic bridge financing problem, but on a very large scale with government credits.
Definitely something to watch. Finding ways to monetize those credits faster could be crucial.
Absolutely. Turning credits into deployable cash is key.
Well, that's a great place to wrap up this deep dive focusing just on those CFO financials. Really appreciate you breaking down the numbers.
My pleasure. Always good to get into the details.
Until next time on the deep dive.